I want to talk about a momentum indicator that I think is genuinely underused in position trading. It's called the True Strength Indicator, or TSI, and I've been using it as my primary tool for a long time, across several thousand trades going back to 2007. The reason I'm making this video isn't to give you a setup or tell you when to enter a trade. It's to explain what the TSI actually is, how it works structurally, and more importantly, how to think about it correctly. Here's the problem I see with most traders who try to use momentum oscillators. They treat them as triggers. They see a line cross and they execute. And that approach consistently leads to frustration because no momentum indicator is designed to work that way on its own. The TSI is different from most oscillators in a few meaningful ways. But to use it well, you need to understand what it's actually measuring, why it's designed the way it was, and what role it's meant to play inside a larger trading framework. And that's what this video is about. Understanding, not execution. The True Strength Indicator was developed by a trader and analyst named William Blau, and at its core, it's a momentum oscillator. And what separates it from something like the RSI or the stochastic is how it processes price data. The TSI takes the raw change in price from one period to the next, then smooths it twice using two separate moving averages layered on top of each other. It then normalizes that result to produce a value that oscillates around a center line at 0. Above 0 means bullish momentum is dominant. Below 0 means bearish momentum is dominant. And the indicator also has a signal line, a shorter moving average of the TSI itself, that helps you see when momentum is accelerating or decelerating. Now, what the TSI is not is a predictive tool. It doesn't tell you where price is going. It tells you how strong the current directional move is and whether that strength is building or fading. And that's a meaningful distinction. It's also not a standalone system. And I want to be clear about that. The TSI gives you a momentum read. It does not give you context, structure, or trend direction on its own. Those things have to come from somewhere else in your analysis. The double smoothing that the TSI uses is actually one of its most important structural features. It irons out a lot of the noise that makes other oscillators choppy and difficult to read. The signals tend to be cleaner and more gradual, which suits a position trader's pace of work. To understand why the TSI was designed the way it was, you have to think about the fundamental problem with momentum analysis. Price moves. Sometimes it moves with conviction. Sometimes it moves without it. And the challenge is that raw price movement alone doesn't tell you which is which. A candle that moves 50 pips can genuinely represent momentum, or it could be noise. Without a way to measure the quality of the move, you're just watching price and guessing. Momentum indicators exist to solve that problem. They try to quantify whether a move has underlying strength. And the TSI approaches that problem by looking at price change, not price itself, and then applying two layers of smoothing to filter out the noise. That double smoothing is the key design decision. Single smoothing oscillators like the RSI can be sensitive to individual candles, which creates false signals and whipsaws. By smoothing twice, the TSI is trying to show you the underlying current of momentum rather than every ripple on the surface. That design makes it particularly well suited to higher time frame trading. And when you're working on daily or weekly charts, which is where position traders spend most of their time, you don't need an indicator that reacts to every small move. You need one that shows you where momentum is genuinely shifting. And that's what the TSI was built to do. So it emerged as a tool for traders who wanted a cleaner, more reliable read on directional strength. Not something to trade off mechanically, but something to help confirm whether the market's behavior is consistent with your own broader thesis. When I look at the TSI, I don't wait for a specific line crossing to make a decision. I'm reading the indicator as a picture of momentum over time. And the first thing I'm asking is, where's the TSI relative to the center line? If it's been above 0 for an extended period of time and it's still rising, that tells me bullish momentum has been sustained. If it crosses below 0 and continues to drift lower, that tells me that selling pressure is in control. The center line gives me a structural read on which side of momentum the market is on. The second thing I'm looking for is the relationship between the TSI and its signal line. When the TSI is pulling away from the signal line, momentum is accelerating. When it's converging back toward the signal line, momentum is fading. And that convergence and divergence between those two lines is often more informative than the crossover itself. And the third thing I watch for is price divergence. If price is making a new high, but the TSI is making a lower high, that tells me that the move is happening on weaker momentum. It doesn't mean price will reverse immediately, but it does tell me that move is losing its internal strength. And that's a meaningful piece of information when I'm thinking about whether to stay in a position or manage risk. What I'm doing with a tool like this is building a layered read. The TSI is one layer. It adds a dimension to the chart that price alone doesn't provide. The most common mistake I see with the TSI and with momentum oscillators in general is using a crossover as an entry trigger. Someone sees the TSI line cross above the signal line and buys. The market moves against them. They conclude the indicator doesn't work. But the problem isn't the indicator. The problem is the framework around it. A signal line crossing on the TSI tells you that momentum shifted in that moment. It does not tell you that the overall trend supports a move in that direction. It does not tell you whether price is relative to the structure. It does not confirm the larger market context aligns with that signal. And without those other elements, you're trading a data point in isolation, and there's always going to produce inconsistent results. There's also a misunderstanding around the center line. Some traders think that if the TSI is below zero, you can only take bearish signals. And if it's above zero, you can only take bullish ones. In practice, it's much more nuanced than that. A bullish signal line crossing below zero can still be meaningful, particularly if it aligns with things you're seeing on the chart. The center line gives you context, not a rule. The other area where understanding breaks down is around overbought and oversold readings. When the TSI reaches an extreme, when there's a large gap between the TSI and its signal line, traders sometimes interpret that as an automatic reversal signal. It isn't. Markets can stay in extended momentum conditions for a long time. Extreme TSI readings tell you momentum is stretched, and that's useful information, but it's not a trade signal on its own. The TSI earns its place in the position trading framework as a momentum confirmation tool. That's the most accurate way I can describe its role. And when I've already identified a trend using something like the least squares moving average, and I have a directional bias based on price structure, the TSI helps me confirm whether momentum aligns with that bias. If the trend is pointing higher and the TSI is also rising and above the center line, those two things are telling me the same story, that alignment adds confidence to a position. When I'm looking at a chart pattern, a double top, a head and shoulders, a significant support or resistance level, the TSI helps me understand whether a breakout or reversal has momentum behind it, or whether it's happening on thin, unconvincing momentum. A pattern break accompanied by a TSI that's shifting in the same direction is more meaningful than a pattern break where the TSI is flat or moving the other way. The same applies to candlestick patterns. A bullish engulfing candle is interesting. A bullish engulfing candle where the TSI is simultaneously shifting from bearish toward neutral or positive, that's a more complete picture. Now, where does the TSI not belong is its first or only input in a trading decision. It's not a trend tool. It doesn't give you structure. It doesn't tell you where the big money is positioned or whether a currency pair is in a long-term uptrend or downtrend. Those things have to come from your broader framework. The TSI sits within that framework as a confirmation layer, not as its foundation. Position trading is about building a complete picture before making a decision. No single indicator does that alone. Not the TSI, not any other tool. What the TSI offers is a clean, well-designed read on momentum, one that's particularly well suited to the pace and time frame of position trading. And when you understand what it measures and use it in the right context, it adds real value to your analysis. It helps you distinguish between moves with conviction and those without. But that value only comes through when it's part of a layered approach. Trend direction, price structure, momentum confirmation, those three things working together give you a more complete read on the market than any one of them does on its own. The goal isn't to find a single indicator that does everything. The goal is to build a framework where each tool has a defined role and where you're not asking any one tool to carry more weight than it was designed to do. The full article behind this video, True Strength Indicator Trading, 3 Winning Methods, is available on positionforex.com and is linked in the description. It covers everything we discussed here in written form, what the TSI is, how to interpret its 4 core signals, the settings I use, and how to apply it alongside the LSMA, candlestick patterns, and chart structure. It's built to serve as a long-term reference, and I'd encourage you to read it alongside this video for the complete picture. Until next time, best your trading.